Good afternoon, everyone. It is 3:30 Chicago time on Wednesday, the 10th of August. A quiet trading month so far of 2016. This is a public AMA session. We hold these sessions once a month, usually the second Thursday of the month, but because I have a webinar with Futures.io at the same time tomorrow, we've shifted it up one day. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. We don't have rules for the session because the questions have been pre-submitted in the on the page that you signed up from. Also on the GoToWebinar registration, there was a form. We actually tapped out. We reached 25 questions, so the form was disabled automatically. And if you wanted to submit a question and couldn't, we apologize for it, but the reason we limit these questions is because we don't want this to run too long. We're trying to keep it to about an hour or so. After an hour, we start to lose people and it gets to be too long. Anyway, so the questions are, the order in which we're taking questions is we're prioritizing non-stage 5 members, and the reason it's not discrimination of any kind. The reason we do that is because stage 5 members get to have this conversation on a weekly basis every Thursday. So we push those questions for all pending and existing members to the bottom of the list. Otherwise, we're looking to answer these in chronological order. I used to separate them into categories, but that was too complex because sometimes I didn't get to a category before the time ran out. So that's the background. Again, we have Richard, who I'll bring on here. Richard is helping me stay organized. He also helps answer questions as I'm talking so that I don't lose my train of thought. So I really want to thank Richard, who's volunteering to assist me with these webinars. Richard is a stage 5 member. Richard, are you online? Are you with us?
I am. Thank you.
Thanks. Okay, so let's kick it off. No sense in talking about anything else. My preference to enter a trade is to set limit orders at levels where a lot of trades happen. Example, a high volume node. For those who don't know what an HVN is, where is theoretically the best place to enter a long trade? Right before, at, or below the high volume node. See the attachment. I was ready to enter at 2177. Should I better look for entries before volume picks up around 2178 and a quarter, or is the HVN normally a good price to enter? And this is the image that Peter here is referring to. So he's looking at the high volume node. Did not pull up my Epic pen again. In fact, it's not even installed on this machine. Let's see if I can mark it up with this. Let's see, let's use yellow. So he's talking about this this high volume node. This is the point of control right here, and the question is, should I be placing my orders to get long at this price? And it's really an impossible question to answer because it just depends on so many things. It depends on your time frame. Are you swing trading? I'll tell you what I do, and then you can kind of figure out where that fits in your trading method. Again, the question is whether we should place limit orders in the areas we're interested in trading and just let it sit out there. And if so, what is the best price to do that? Is it the above the high volume node, below, or at it? I don't put orders out there. I'm a proactive trader. I don't like having orders sitting out there for the market to take. So I use a combination of tools to not only decide what my bias is going to be. But also I like to see, or I prefer to see what the market is doing at that location before I step in. I don't want to take more heat than I have to. A lot of times you'll find, especially on the ES, it's not too bad, but on other products, in order for you to do that, you have to use a very wide stop, probably a full harmonic rotation, to be able to stay in a trade. And it makes more sense to do that if you're a swing trader or a longer-term trader, a multi-day trader where you're playing these this example here. What you're seeing, this volume profile that we're seeing here, is a composite. It looks like a micro composite going back to probably sometime in early July based on the prices. I don't see what it is here. And if you're trading off of these levels, you're basically trading at a higher time frame than I, so it's hard for me to comment on that. But my, the additional thing, I don't know if you watched the webinars on my website, but the additional thing is initiating at a high volume node. A high volume node is created because a lot of interest took place there. A lot of trading took place. It was seen as a fair price. Generally, high volume nodes get a lot of chop. So this is not a coincidence right here. This is part of what formed the high volume node, and we have to see what happened before there to figure out if this was likely to happen. Back here, if the market moves down here, it generally doesn't move down to the highest volume price and bounce off. It generally does not. It generally comes in and it's an accepted price and trades through it before it decides to attempt higher, fail, and continue, or chop, attempt lower, fail, and continue higher. So trading in these high volume nodes means that you automatically have to have a very wide risk profile or high risk tolerance. So putting your order in the middle of this means you have to be able to take, that much heat. Okay, so it's not my style of trading, and I just cannot answer whether the order should be put at that price or not, because I prefer to see what it does at that price, what the reaction is at that price before I place orders. Generally, I'm actually using market orders, or I join the best bid or the best offer to enter the market, depending on how much size I'm putting on. Carlos is next. Carlos is asking, FT, how is day trading CL different from day trading ES? How significant is the OS, IB, VA, VP in your decision process? So, Carlos, my approach to trading the markets is the same across all products, including investments in equities, in whatever equity you're looking at. It's just a time frame that changes. And so, and with that being said, a product like crude oil. So let's take a look at crude oil here. A product like crude oil is much thinner. It's also a fairly fundamentally driven product with demand supply pressures and things like that. It tends to run through a lot of prices. So my expectation for crude oil for today, opening below value in range. My expectation for crude oil for today is a push to the point of control, which is right there from yesterday, and it stopped just a tick below it right here. And the opening swing is the same. We had a bit of a drive on the open. It's an OTD open because it pulled back part way, but the opening swing was right there. And then it broke the opening swing high, pulled back, went to the point of control, and it started to sell off. Today is the inventories day. On the inventories, it broke higher, and then it broke lower, and it triggered off a beautiful trade at the mid right here. I talked about it in the S5 chat room. chat forum, and we had a continuation trade. The impulsive trade, pull back to the mid, continuation trade, and then chop into the close. Remember, this product closes at 130. And so how is that different than the ES? It is faster. The product tends to run through levels by a little bit. That applies to the NASDAQ, the DAX, sometimes the Dow, definitely the Russell, gold for sure, silver for sure. All those products tend to follow the same patterns because we're trading an auction, and that's what a lot of people who come into trading, whether it's from equities or from no trading experience at all, what people forget is that we are trading an auction. This is an auction. This is just like your local flea market. We are, as traders, we are battling each other to determine, to help the higher time frame, the institutions and the higher player in the market. We're helping determine value, and that's what this is. And all products do that. Some products do it more cleanly than others. With the ES being the most moderate of the bunch when volatility is high enough. So your question regarding whether the same decision process applies, yes it does. The same hypothesis process applies, the same habits, the same approach, the same stalking trades using some sort of an order flow product, watching what it does at liquidity, how the market responds in areas when I'm expecting it to respond, and so on and so forth. All of that stuff applies just the same. This is why, for those of you who have been following since I came online in 2009 or so, you're probably bored sick of this stuff that I keep saying, because it has not changed, for the last 7 years. It did not change before that for a few years, and it continues to be the same. And this is why I stick with this approach. You can always pile on your fibs or your indicators, RSIs, MACDs, whatever you want to use. You can pile that on top of what it is you're doing. Whatever it is you're doing, as long as you understand the auction and how prices explore and test and rotate, you can throw other stuff on and gain what I believe to be a much, much stronger edge. This is why it was important to me to come on and just share this information with you. Next question, Michael, a momentum trader. What's your advice on breakout, fake outs? How to use order flow to confirm a breakout? So breakouts are, so let's go back to 2002 through 2005 or 6. Breakouts were great trades. I was trading the DAX very actively, very, very heavy at the time, and you could always buy a high and put orders out, 6, 7 points away in the DAX, and it'll automatically take out the high and sweep to your offers if you're long, and that was a great trade. If you try to do that in the DAX today, you'll probably get run over, probably go 1, 2, 3 ticks above and fall like a rock out of the sky. So I'm not a breakout trader, and I just don't like commenting on things that I don't really do or know about or use. But order flow always helps in helping you decide what kind of reaction you may expect. So let's look at, for contrast, let's look at the NQ, which has a fair amount of breakout trades in it. But if you see that there's an offer that's sitting there, like this offer at 82.5 this afternoon, if you see an offer sitting there and it breaks through that offer and you get a collision on the downside, even if it's a collision on the upside, and it pushes through and it starts to come back, the key element that I look at here is the retest. Where's the retest? Right there. So it breaks it, takes out that size. So as this was going approaching that size decided to hit the market rather than for the market to come up and actually trade it out. and then you get the stop run. Once that size is gone, you get all these people who are leaning on it, kind of you know, we have these perma faders, runs through, and then it pulls back. And then this is an important indication right here. This is what I look for. I look for the retest of that key area before the market decides to make the next move, and the next move is generally to rotate lower. If you had a gun to my head and you forced me to take either a breakout or a reversion trade, I will tell you that more often than not, I would take a reversion trade in this environment. The volatility is just not high enough. You can see here in the NQ, once that high volume offer came through, this would have been a breakout trade for you. It just completely rotated the other way for about 10 points. And then look at what happens. Watch the 8250 here. Look at what happens. Boom. See that size again at 8250 hitting the market? Then what do you get after that? You get a retest before the next move. And then here's a secondary retest. This starts to weaken this level, and then you're likely to see it go higher. So as we closed here, as we're closed and then we reopen, this is likely to creep higher as it retested this level again. These are all kind of order flow scalping ideas that I'm talking about. But as far as being a breakout trader, I would say caution. I know momentum requires you to be somewhat of a breakout trader, but I don't do it because in this environment, I think you would see a low win rate. But when you do catch a breakout that has momentum, it can more than make up for your losses. This is how a lot of funds trade. A lot of funds are looking for trends with a low win percentage. How are we doing on time, Richard? Doing okay?
Yeah, you've been averaging about 5 minutes a question.
Okay. Greg is asking, you've said many times to make your entries with stops in such a way that the market has to work hard to trip them. Could you show how that idea works when one is looking at both kinds of charts, distinguishing between charts with and without volume? Information as always, thanks a bunch, okay? So I'll show you one that we talked about this afternoon in the chat forum. I'll go over a very simple setup. I'll take a few minutes here. The market, opens, tests higher, unable to take out. This is basically the trader bite. I'm going over the trader bite, what I'm going to say in the trader bite tomorrow, essentially, because this is what happened. The market could not get to the LVN. It tested higher, and then it started to rotate down and out of range or out of value. It was unable to go, and then we have this, what I call an impulsive move, which is a move that is better than 2 standard deviations of what is normal for this product. Okay, so about 4.75 points, and that's been crunched recently with this low volatility or higher. I start to look for an impulsive move. It's not just the rotation size that determines whether it's impulsive or not. It's actually the structure it is working out of. In other words, if it's moving away from balance, which is what this is, then it's considered an impulsive move. And the conversation in the chat room was, I'm looking for this to consolidate, build a high volume node here, so I'll show you what that looked like. This question may take longer than the others, but I think it's important to see what is going on. So this is the profile as it was forming. Let me move this, shift this forward. See how it's forming this high volume node here. And as I move forward, it's doing its job. It's put in a weak low it's like a double bottom on a 15-minute chart, really. So that's a weak structure. We have an impulsive move down. So the setup for this and the trade for this that I was talking about in the room is drop, chop, push up to anywhere between 73.50 and 74.75 or so. That's the area it's likely to retest. I don't know where it's going to go. And what I said is, If it gets above 76.25, then it's wrong. That's about a 3.5 point stop. But if I can get the 73, if I can get the 73.50 or so, the distance from there to the low is better than 1-to-1. That makes my profit target balanced with my risk, but the expectation is that we get a continuation trade. So the expected action here is a pullback to somewhere near the mid and then a drop. Why do I select the 76 or so as a stop? The reason is for it to get to my stop, it has to, at this point, work through this low volume node, then get in above the IB low, get in above the mid, get in above VWAP, and start working its way up this high volume node, the highest volume node of the day. If the market can do all of that, then I am wrong. It should not be able to do that. Not that it shouldn't. The market does what it does. I shouldn't say that. But it's very likely to continue higher. And that's what that means, to place your stop or to place your exit at such a location that the market has to work hard to take it out. What is a stop that is not hard to take out? Prior highs, prior lows, previous bar high, previous bar low by a tick. Those are all easy targets. And what that means a lot of times, if you're not well funded, if you're not trading a $25,000 or $50,000 account, what that essentially means is that you have to reduce your time frame so low on your charts so that you can find those little structures to decide to be able to take out your stop without having to use a huge range before you're stopped out. But for the market to take that trade out, this impulsive down pullback for a continuation, in order for the market to take this trade out, it has to get through a lot. And what does that mean? That means the market has to work hard to basically cancel out your idea. Like I said, if the market got back up there, I am absolutely wrong on the short. And it could have easily done that. It's been doing that a lot recently. But I'm not placing my order in some random distance. Yeah, I entered here and I always use a 6-tick stop. You have to look at that stop and say, what is the chance that the market will hit that, or how difficult would it be for the market to hit that? And if it's sitting in the middle of nothing, then it's very easy for the market to hit it. So you're just basically donating 6 ticks to the market, $75 a contract. That's what that basically means.
And your entry on that, was that a mid-trade entry that you were looking at?
I was, so on this trade, it was a mid of the rotation. That's the first stop, right? So the mid of the rotation was, let's throw a fib on here. So it started out actually before the mid of the rotation. So it started out at 73.50 ahead of the prior day's low, because the prior day's low could act as resistance if short-time traders are in control.
Okay.
And then I'm looking at the mid of the move as the first kind of ideal trade, but you could see that the mid of the move is just above the prior day's low, and then I would add in the 74, 75 area. So I'm happy to add all the way up to the IB to bring my stop up closer to, or my average up closer to my stop, which was at 76.25. So the range I gave in the chat room was, I believe it was 73.5 to about 74.75, with an exit above 76.25. That was the plan for the trade, and the target was 2170 on the bulk of it. The scale out is standard at about 8 ticks, so something around 72. For a scale out, that would improve my average, bring it better, closer to the stop, and then the key thing the market is likely to test is that last low on this impulsive move, and then anything below that, any extension below that or continuation is what I would call gravy on the trade overall.
And someone's asking that you tell them what your favorite child is. No, what they're asking is that your best setup? You don't.
I don't have a best setup.
That's what I thought.
Yeah, it's a good analogy. They're like children, you know. They have their
Yes.
goods, they have their bads. They irritate you some days, and some days you're proud of them. But it's really contextual. So I cannot say that, hey, this is my favorite setup, or this is the key setup. This is a billion-dollar set. It's this setup. I mean, I could pass on the setup. This exact same setup, I would pass on it and not take the short if I have confluence down here that the market tested. In other words, if I have an area that's big, a much higher time frame that the market pulled back to and starts bouncing, I'll pass on the short because this test, the area that it just tested, may be so significant that it's likely to start the next leg up. And so I will not stand in its way unless I want to scalp short. So there is no favorite setup. I have a tool set. Go to a carpenter and ask them, you're a professional carpenter, what is your favorite tool? And you'll get probably a finger gesture that is not so flattering, because they need a bunch. They need their hammer, they need their square, they need their measuring tape. They don't have a favorite tool. You can't fix everything with a hammer, although some people in my family think they can. But that's trading is the same. It's just one tool, and you use it at the right time. There's a nail, it needs to be driven, you use a hammer. You know, there's an impulsive move out of range from balance into imbalance, has a pullback, boom, we look for confluence of prior day levels, LVN, IB, mid of that move. All of those things come and work together to give us an edge on that particular trade, So it's discretionary, but it's structured, okay?
Now, some have noticed that you've changed your chart a little, and you've got some shaded areas. And I thought if you'd take just a moment to speak about what changes.
So this is, I'm basically painting bars, the background here. This is kind of an experimental thing, because the market has been so slow. What this does, like if I scrunch it down, what this does, the wider the area, it tells me that there are more bars, and because this is a 2-tick Renko, it's telling me that there are more 2-tick bar ranges in there within that half-hour period. So these are all half-hour periods. That's a half-hour period, that's a half-hour period, and so on. But if you look at here, it took the market a half hour to print 3 2-tick bars. It's dead down here. It just sat there for a long period of time doing nothing. It's not something that I'm trading off of, but it's something where I look down and I can look up at the chart and I can see if there's been some action. Okay, and it's somewhat deceptive, because if you get an impulsive move, you might get a lot of bars in a very narrow 30-minute range. So you have to be careful there. But in general, you'll see when you throw this onto your charts, you'll see that the beginning of the day is the widest period. And then at some point in the day after it balances out, it widens out again, and then into the close, it's fairly narrow. It just tells me when the periods are that create, that give some volatility opportunities, because it's been so dead. Again, it's not something I've mastered or are using for trading, but it's just from a distance I can look at the chart and see that it's not doing anything, or it's doing something at that time. Okay.
Thank you.
On to Jeff. Jeff is asking, when price re-enters a balance, do you expect it to rotate all the way through to the other side, back to the LVN? Basically, how do you decide if you think a balance will be fully auctioned or if it'll be quickly rejected, like at the balance's VPOC? So Jeff, that's a great question. There's no way to know. Context helps you, like the stuff you hear about, the logic you hear about in the Trader Bite helps. But here's what it would look like. Let's look at yesterday's example. So over the last couple of days, we've been testing the point of control and bouncing off of it. And then that creates a conflict with the idea that if the point of control is the highest volume price, isn't that a balance area and shouldn't it chop through there like you always say? You're right. But also what happens is it tests the point of control and it starts to break away. What gives me a clue is what happens next. So in this case, it tested the point of control, pushed up to the LVN, pulled back to the mid, and pushed through the LVN. I'm not looking for this to come back here immediately. It may come back here later, it may not. But if instead you have a structure that looks like this, I'll show you what it would look like if I expected failure. It opens, tests up, goes to the VPOC, and at this point I'm still sitting on my hands, and I see it pushes up, then it comes down, breaks through the mid, tries to push up, it's not able to, and then starts to push through the point of control. Well, the setup here is look for a short in this area, targeting what? Targeting value low. You're in balance, so you're looking for it to rotate to the other side. That is a natural thing for the market to do when it's in balance. It's checking all the way through. So we've already tested the value high right here. We've already tested that and we've fallen through. It creates an opportunity for a test of the other side once we come back to the point of control and fail through it, which is what happened later that day. Okay, pushed all the way down. You can see that the low of the next day was right here, right at a tick below the point of the value low. So let's look at that here. There's the low a day. See that? 73.75. Value low is 74. That is a natural balance behavior, and you know, I made videos in 2009 and 2010 that cover this, and here it is happening yesterday. It is not unusual. So you can't just, one of the things that I noticed based on the questions that I get all the time via email and through AMAs is, as human beings, we like to create a rule that explains stuff, that explains life. You know, if the person is dressed this way, then they're a thug and they are dangerous. If you know, somebody does this, then expect that. We like to simplify things because it causes less stress on us to explain them that way. And what I learned through trading, and that's the mindset I came from, by the way, as an engineer. I like, use Pythagoras to figure out your angles, and boom, you've got an answer, and that's it. Or Bernoulli's equation or whatever. And so you're educated into this idea that you can explain things nicely and nice and wrapped, but through the market you're trying to explain. Your goal is to explain, or what you're trying to do is explain human behavior, human greed and fear, and it's much more complex. And so whenever I talk about context and answer the question with "it depends," you get this eye roll like, oh, here comes the BS answer, the squiggly answer, the non-firm answer. But the nature of the market is such that it all depends. It depends what it has done recently, how good of a job it did, what it's trying to do, what it's likely to do next. And that's why we have to this is why we have to keep asking those questions throughout the session. What has it done? How good of a job? What is it trying to do? All that stuff. And then we can decide what is the next rotation. What is the next likely rotation or probable rotation? And it all depends on where we were. You know, it's like telling a story. You have to know what happened before that to be able to predict what may happen next, just like in real life. Josh is asking, what do you do with your futures profits or excess money? Do you reinvest it or leave it in your futures account and increase your trading size? So let's not talk about what I'm doing. Let's talk about how I manage a new prop trader's account. So a new prop trader has a house account that has $25,000 in it, and that's all they get. That includes all their costs and everything, and generally people draw that down, traders will draw that down to about 70 to 85%. That's how much they lose under an intense kind of deliberate environment to make the turn. So you can set your expectations based on that. However, when the trader turns, in my experience, they make that money back very quickly. It's a matter of a couple of months before they're back to break even. Now, when that account starts building every month, we generally sweep it. We don't like to, what I don't do is keep adding to a trading account. You have to do that in the start as you're learning. You have to keep funding an account, unfortunately, because your education is happening in real life, just kind of just like a college education. But what I'm doing with excess money is pulling it off, because the funds in a futures account are not guaranteed, are not insured. There is no SIPC insurance in futures, and there's a good reason that there is no SIPC insurance in futures, is because historically, and this is not to predict the future, historically people have not lost their entire trading account in case there's an FCM failure like MF Global, PFG, or whatever. It takes time to recover the money, but there is no insurance that kicks in. And because there's no insurance that kicks in, the cost of trading futures is much, much less, in my opinion, than the equivalent cost of trading a stock. Also, in futures, you do not get charged interest on your margin. So if you're trading the S&P and you're trading it at the margin that I like, the intraday margin that I like, which is 50% of the exchange margin, so let's call it $2,500 a contract. Let's not talk about the suicidal $500 contract that everybody wants. At $2,500 a contract, for every contract you're managing a $100,000 position. Take today's price, 2170-ish, times 50. That's basically the notional value of the ES. In stocks, you can get a margin account, but you'll be paying your broker. It's your broker that's loaning you that additional buying power, and you're paying interest on it. In futures, you do not pay interest, and to hold that position, you pay much lower fees. And so because of that, you want to sweep your account and leave just what's necessary in order for you to trade the size you want to trade, plus any drawdowns. Okay, what you don't want to do is sit there and say, I had $5,000 and now I have $10,000, therefore I should trade twice the size I was trading at $5,000. The size you trade has little to do, or it's only one factor. Capitalization is just one factor of the size that you trade. The size you trade is a function of what your expectancy is doing, what the trend is of that expectancy, and if you are ready, if you are in level of competence, if you're emotionally ready to increase that size. So you can sit on $1 million account and still trade 2 lots, and I wouldn't recommend it because you're putting a lot of money at risk, but you know, and remember, in futures, your money is always segregated. You know, the company, the clearing firm, the broker never has access to your funds, by the way. The clearing firm does. You never deposit money with your broker in futures. It's the clearing firm, and the clearing firm, by law, is not allowed to use your funds to run its business, and it is audited. It has to account for those funds on a daily basis, on a mark-to-market basis. So that's why your account's always debited or credited at the end of the day, so you know exactly where you are. Anyway, that's what I would do. Only add funds if you want to increase your size and you need the additional margin, but other than that, always sweep your account. Take money out, and that money needs to sit away from your expense, your household expense money, because it's money you may have to bring back. Hopefully not, but that's how I manage it. Eric, what's the start date on your longer-term composite market profile in ES? So I think you're talking about the micro composite, because the big composite, this black profile that sits here on the side, that starts on this date, October 9, 2013. It's using minute bar volume until about 60 days, and then it uses tick 60 days from today, and it uses tick volume. As far as the microcomposite, we're working off of a new microcomposite which started this last Friday with the non-farm payrolls on the gap up. And as soon as on Monday we traded into the non-farm payrolls, here I can remove this, so you can see that we traded Friday there, and on Monday we had a balance day. As soon as I see that Monday's balanced inside of Friday, I immediately put on a microcomposite of those 2 days. Now I want to see those 2 days auctioning together, how they auction together, and then we keep moving that forward as Tuesday traded inside of Monday and Friday. Now we move that profile forward to see how it's developing, and as you can see today, we traded inside of all of those days. We traded all the way down through Friday's tail, and so today gets included in here, and you could see that the microcomposite's getting a lot of what's called kurtosis, and that's not a medical condition. It's basically describing how sharp or how concentrated this volume is. And the more concentrated the volume is over the space of the range, over a smaller range, that describes that there's more and more energy for the breakout. And we kind of got that today. We got the breakout onto the downside. Now, let's say that tomorrow this profile or this market decides to trade like this and then drop, and all of a sudden it's dropping inside of the range of this microcomposite. If that's the case, then I will pull in that older microcomposite forward. So I'll erase this, and I'll start bringing in this microcomposite forward. And that microcomposite started on the 8th or the 12th. I think I shifted it back up to the 8th. And so now I can see how it traded across this entire range. Looks like it's on the, 11th. Okay, so 11th. Okay. So now I can see how it traded across that entire range, and we can see that the big point of control we're aiming for here is 2160.75, and that's going to be the key price tomorrow if the overnight session doesn't go any higher, doesn't come out of value today. Then 2160.75 becomes our key price to test, or our key target for tomorrow. You see how that's all kind of built on each other? That's essentially where all those ideas come from.
Just on time, we're almost 4:15 Central, and we've only gotten through 7 questions. So
we'll start racing through.
Excellent.
Okay, Dwayne, I'd like to go off the subject of day trading futures for a bit and would like your views and approach to the macro environment. Oof. How do you deal with things mentally and actually regarding longer-term economics and still remain focused on the process of day trading? Okay, Dwayne, I'm not going to read the rest of it just to kind of run through. I'll tell you this. Why don't you decide what you want to be? If you want to be an economist and an analyst or a hedge fund trader that's trading the fundamentals, or a multi-month trading style, or maybe you're trading off of what's happening in the treasuries, then you should worry about all the hyperinflation and macro this and how much, M3 supply and all that stuff. I like to read about that stuff. I like to know what that stuff is just out of interest, but it does not influence my hypotheses on a day-to-day basis. Just because the Fed, said something or has decided something last, 2 Wednesdays ago or whatever, does not affect what my hypothesis is for today. Why? Because I am steadfast and focused on my time frame, and that is a day time frame, because that's what I trade. I don't take positions into the close. I'm not holding options till 6 months out, so I don't really care about that stuff. So to answer this question, how do I deal with that? I deal with it by not worrying about it because it's outside of my time frame. Think of yourself being a pilot who flies between 2 cities that are 200 miles apart. you're essentially worrying about a hurricane that is sweeping through Africa. Yes, that is a system that may affect the weather in your area on some level later, but to make the next flight 200 miles away into the next city, it really isn't something that's going to influence how your flight path. It's going to be the same. That's the same in trading. Don't take in more than you need to, because you start to actually color your you start to color emotionally what you see in the market, and that's not a good thing. Camilla, are entries for trades based on the order flow liquidity software uses? For someone not using the software, what would be the best advice? It isn't. My entries are based on my hypotheses. My hypotheses are key cornerstone of what I'm doing, and the hypotheses are built on all the information I gather from session to session. I go through those on the Trader Bite every morning at 8 Central, 9 Eastern. That's what that's for. It's me kind of offering, here's what I'm looking at. And then the entry itself is really based on just thousands of hours, I would say, of watching the market and how it behaves, watching a short-term chart, my trigger chart, but using something like Bookmap makes that process easier. It helps me see where the liquidity is at any given time. It helps me see how certain bids or offers are behaving. Is this offer here moving as we move towards it, or is it not? That's what this software does for me, and it does it better than any other that I've used personally. That's just my personal opinion, although you have a whole world of different products, a Jigsaw and so on. So you don't have to have the software, but it just helps kind of simplify things, and it helps me explain a lot of things nowadays. Jean or Jean, don't you have second thoughts about providing a signal such as Chris's through your website, since this kind of service makes people more passive and less likely to learn for themselves how to trade? You're talking about the automated trading system to master themselves and make their own decisions. Also, less likely to see themselves as the cause of their own success or failure instead of falling into the trap of feeling lucky about their signals provider if they're profitable. So there's nothing I do that provides signals in any way. I stay very, very far away from that end of business. I do not provide any trade signals or trade recommendations. It creates a compliance nightmare for me. It creates a lot of risk with no benefit. So I don't talk about that. That's why I focus on the process. I think that's where people fail, is in their process. And you should watch you should attend tomorrow's webinar with Futures.io and watch the first two parts of the series because I cover all of that. Tomorrow's is going to be particularly important. So, the purpose of the automated trading system that's offered through Stage 5 Trading is as a side thing. It's for those people who can't be in front of the market all the time, who don't want to take the risk on investing in someone or having someone else trade their account, but to have a system do it. It's not a replacement for someone's trading skills. It's not intended for something that you watch and trade. It's trading for you. So the purpose, I think maybe there's a misunderstanding about the purpose of that program. Robert, regarding your scale-out trade management strategy, how do you measure risk-reward? It seems like the first scale-out target would need to be greater than or equal to your stop location. It does not. But I don't think that has always been the case in all of your examples. Webinar 5 had a 5-tick scale-out. It doesn't have to be. The overall trade needs to present at least a 1R ratio of risk. So that's the overall, but the scale out is just there to improve my overall position against my stop. And so it's really, so, let's say you enter short at 2180 with 2 contracts, and then you automatically have a scale out that's an order sends other or something like that at 8 ticks. And so you have one exit at 2178. Once you get that fill, you're essentially, it's the equivalent of you being short 2181 with one contract. Okay, so you entered 2180 with two contracts, got out for 2 points, and you have one left. You've just improved your position by 1 point. This brings you closer, your entry 1 point closer to your stop, gives the trade a lot more room. If your stop was 2 points away, let's say it's 2182, and the market just filled you at 2178, the market has to move now 3 points instead of 2 points to break even your trade, and it has to move 4 points to stop you out. So you just gave yourself a point extra of room, or you've reduced your overall risk by a point. But does that mean that that's what you're going for, the scale out? That's not what you're going for. That's just a way of managing, mitigating risk and potentially managing your emotions. This is why I scale out. I only relax even after having done thousands of trades. I only feel relaxed once I get a scale out. It's a psychological thing. I'm aware of it, and it's okay. It's just a way of managing and keeping that chimp mind away and keeping focus on what's meaningful for this particular trade is when I reduce risk. I'm not colored by fear in that situation. William just wanted FT to give his thoughts as to what a good expectancy is for the intraday NASDAQ trader per trade. I trade sub 5-minute charts and do not hold overnight, typically shooting for 4 to 6 points per trade, 2 to 3 trades per day. So you're looking at probably an expectancy of about 5 ticks or better overall. Remember, expectancy includes your losses, so it's an average on the NASDAQ because of the harmonic on it and because of how much it moves. Generally, you're looking at probably somewhere between 5 and 8 ticks or so. A 5-minute trader, that means you're holding positions probably for 15, 20 minutes at least. And generally, you want to be in the 5-tick range or so before you start adding size, in my opinion. Kamrul, what is the best way to get an opportunity to work in a professional environment like a prop firm? 5 years of experience. Question is, do you give an opportunity to person? I do not currently back traders. I don't have, I'm not in that yet, although it's really an objective at some later point. The first step has been to build the tools and help build stage 5, but eventually I will be back in prop, and it's proper prop, not the prop that we see today online with all the different combines and stuff. I'm not interested in that. It's great for the people who do that, but I'm more interested in a straight prop situation, and that's not going to kick in for some time. There are several steps that have to happen, and they've taken a lot longer than expected. But currently, in the current environment, I do not back traders at all.
Murad, if you got a moment, we got a follow-up from Robert J.
Okay.
In the questions that I thought, if he had it, he says, yeah, but if you get stopped on your entire trade, then your risk to reward does not work out because your final target is only being reached with half of your initial size, but the stop would be hit with all of it if you don't get the scale up.
How does that affect the fact that the overall, so you're thinking, we're not talking about a binary trade here. We're talking about, it's a 2-contract position, a scale out for 2 points, stop for 2 points. If you scale out and you stop out, you break even. Okay? If you don't scale out and you stop out, you lose 2 points. But you would lose 2 points if you didn't scale out anyway. So it's not really improving anything. However, if you scale out for 2 points and now improve your theoretical average and hold the 1 lot, you're not getting out of the 1 lot for 2 points. You're looking to get out of the 1 lot for its intended target, which is generally much farther away. So the overall risk reward is 2 points with a 2-point scale out, but an exit that's probably somewhere around 4 or 5 points on a full rotation, of multiple rotations. So the overall gain is somewhere around, let's average it out at maybe 7 points, with an overall stop that's 2 points for 2 lots at 4 points. I don't see how that's upside down. The risk reward
Okay,
is always going to be 1-to-1.
so do you, just to clarify, he's asking, so then you use your scale out to the 1-to-1 ratio that you're looking for?
The scale out doesn't have to be on a 1-to-1 ratio. The issue with the scale out and what you saw in that webinar 5 is that I will not stubbornly hold for a 2-point scale out on a 2-point stop when I see that there's an area that is difficult to get through. So I will take a 5-tick scale out or a 4-tick scale out. I don't like it because it's not improving my position very much. So a 5-tick scale out on a 2-lot is only improving my position by about 2 ticks. It's not doing very much for me, but I'm also not a stubborn trader. I know that if I have to take the chance that I might scale out and it might come back and take me out, I would rather have it take me out with a scale out and half the position or less. But if it does break through that area that's a confluence area that caused the 5-tick scale out, now you have a much stronger trade. In that situation, you don't just get out for another 2 ticks. In that situation, you're holding that trade for a runner. That's the goal. So in general, I'm looking for 8 ticks in the ES in general. But I'm not interested. My goal is not to balance this scale out with a stop. That's not the goal. My goal is to improve my position by reducing my risk in some way, but I'm also looking for that last contract. I'm giving room for that last contract to run quite some distance. But overall, my target for both the scale out and the final trade, assuming I'm trading a 2-lot, is at or better than 1R risk or 1-to-1 risk reward. Any less than that, and it requires me to be a lot more accurate to actually make money, and it's difficult to do that in this market. So that's the explanation there. Fred, I primarily trade the mini S&P crude notes. My question is, when creating composite profile for longer term, several days or even weeks, do you apply the profile to the 24-hour chart, RTH, or both to find HVNs and LVNs? So Fred, those 3 products have pit sessions. Now crude's a special product because you're trading the actual physical, because crude is physically delivered and it's traded at different key markets. But here's what I've done to simplify just for myself, whether it's fake or real, I don't really care. For crude, I just look at the NYMEX pit session, because that's the session. If you do volatility studies, if you test the ranges and the opportunities in crude, they're really best during generally they're really best during the U.S. pit session. So pretty much everything I look at has to conform with the underlying market. So for notes, when I'm doing the analysis for the charts, pretty much all charts that you see, whether it's S&P notes, crude, they're pit session charts, because I am trading the futures while the underlying product is live. I don't want to trade a product that's trading in sympathy. So if you do a 24-hour chart of the S&P, and I do look at a 24-hour chart, if you watch Trader Bite, I always pull up, unless there's something really uninteresting in it, I always pull up the overnight chart and look at what it has done to color what I expect at the open. I don't think the overnight chart, as far as I could tell from years of watching this, the overnight chart generally doesn't color the rest of the session. It colors how we open. We were looking for whether inventory is long or short, where the key obstacles were overnight. But once I've done that, identified those, boom, it's minimized. I don't care about it. The rest of the time I'm looking at the RTH chart or the pit chart. I have little interest in the 24-hour charts. I mean, the S&P don't even trade, the stocks in the S&P don't even trade, so you're trading a product by proxy, kind of like trading the DAX after 10:30 Central or 11:30 Eastern when the 30 DAX stocks are closed. You're essentially trading the S&P or the Dow using the DAX. Oops. And I just don't like doing that. Okay, I guess this thing's backing up. So that's that. Angelo, what is the minimum trading account? If you're asking what is the recommended minimum capital to trade with, you're not going to like my answer. I generally say if you're a beginner, to really learn, you need probably around $25,000. What is the minimum you need to trade at most brokerages? About $5,000, I would say. Some of them take $2,000, but I think it's just you're just throwing your money away. And then Stage 5 Trading recommends $10,000 as the minimum initial to open an account. And that's a reasonable middle ground for most people. That's to trade futures. Steve, I'm looking to get into writing systems for trading. However, I'm unsure of which language to start learning. What would you recommend that I go with? That's not a question for me. I know that I've worked on systems in the past, and I've seen everything from Python to Java to there's some systems even running on PHP, believe it or not. It's really a lot of the systems that I've seen run on C# or some version of Python, something like that. But I don't know because I don't actually code systems, so I'm just giving you what I've seen versus what I would actually use since I don't do that. Dan, what resources would you consider essential to be a successful trader? For example, is the IRT software necessary? Is it a good idea to try to trade using volume profile with a time chart, 1 minute or less as the interval? It's really, what car should you buy? I don't know. Do you have a family? Are you a single guy? How much money do you have? I could tell you why I use IRT. I use IRT because it's very powerful. There's a lot I can do with it, and it uses data at the tick level. So my charts, when you look at my intraday charts, they're all built on tick data. There's no aggregation of data. There's no averaging of data. It is clean, straightforward data, and I need to have that because I need to trust that the information I'm trading off of is good information. Now, is IRT the only software that does that? No, there's other software that does it, Sierra Charts and Multi-Chart and all of that. You have to, it's a bit like shopping for shoes. You kind of have to find what's comfortable. But my preference is IRT because there are constant updates. I have direct access to the developers, and I can make it do what I need it to do. And it's not very much of a headache, and it connects to many different data feeds. So there's a ton of flexibility there. It has a bit of a steep learning curve, but pretty much anything you use at an advanced level has a steep learning curve. The things I would not recommend if you're looking to trade professionally are things like, I know I'm going to offend a lot of people, but Thinkorswim, for example, their charts are a hybrid of a lot of things. Interactive Brokers charts, those are great. That's like I call them the AOL or America Online or CompuServe of the internet. They have an audience that they're designed for, and they're good for that. But for really squeezing out as much as you can out of your data, you need something a little bit more robust, and it just depends on how much money you have to trade with. Whether or not you should use volume profiling and 1 minute charts, it's really up to you. My recommendation is always going to be learn the auction, understand the auction, and the best way to see the auction, in my opinion, is through some sort of a profile. I started out with market profile, and I moved to volume profile back in 2005 because I can get the data and see how much volume traded at every price rather than breaking down the market into a time-based evaluation of how much interest there is in price. I think if you understand the auction, and you can use volume profile or not or whatever, if you understand the auction, there is so much you can, there are a lot of areas that you can branch into and build off of, because the fundamentals of the market are auction-based. The market is an auction, and from there you can just build whatever you want and have an understanding of how the market operates. And it actually helps you create a lot of ideas. A lot of what I share are just things that I just noticed and came up with. Nothing genius, really. It's just common sense. Frank, what does the midline on your volume profile charts represent? How do you use it? The midline is simply the high of the day plus the low of the day divided by 2. It's an average of the very high print and the very low print. So you could see it moves down as the market moves down. And the mid is simply, the reason I look at the mid is because I did a study a long time ago, and I marked the mid of every single bar. And I noticed that it often causes a pause on a retest. And so I expanded that idea to the mid of the day and ran a manual test on 5-minute bar charts over a period of about 90 days. And I noticed that under certain conditions, the mid it doesn't necessarily stop the market, but the mid causes the market to take pause, and it takes pause long enough for me to get a scale out, and that became a key tool on the charts. A lot of times you'll find that the mid and VWAP are right on top of each other, especially if you're in balance. The mid and the VWAP just sit right on top of each other, and generally that gives, on a first test, creates a small opportunity, at least for a scalp. As far as how I use it, that's too long for me to answer right now. What I would suggest is consider joining Stage 5. That's a type of question that's handled in the chat forum all the time, or it can be asked during next week's AMA or whatever. It's just hard for me to get into a lot of detail during these general AMAs. I think I'm going to cut it off here. And for Aditya, Barry, Omar, Lee, Sean, Arlen, just hit me up in the S5 chat room or in next week's AMA, and I'll be happy to answer your question. Just resubmit it, please, and we'll address it there. For now, we've finished an hour. We're over by 7 minutes. I think it's good to cut it off right here so that it's just not a super, feature film length AMA, so people can enjoy it while they watch it. If you have questions, just hit me up on my website, FuturesTrader71.com/contact or info@FuturesTrader71.com, and hopefully you gained something from being here today. The recording will go out in just a short while. So I'll cut it off right here. I want to take a moment, as always, to really wholeheartedly thank Richard for helping me answer some of these questions and keeping us all in our best behavior as far as time. Thanks, everybody, and I'll catch you soon. Take care.